Fair value gaps are the one reason that a lot of traders have become profitable, because they give you so much information. And today, I want to talk about what fair value gaps are, how to use them, and what the good and bad fair value gaps are. And it doesn't matter if this is the first time that you've heard of fair value gaps or if it's the 100th time that you've heard of fair value gaps. My goal is to simplify fair value gaps in a way that even a beginner could apply as soon as he's done watching this video. So let's understand fair value gaps. Fair value gaps are a 3-bar pattern, which means we only need 3 candles to form a fair value gap, but not every 3 candles are fair value gaps. So let's see what they look like. So fair value gaps, let's start with the normal fair value gap. As I've said, a fair value gap is a 3-bar pattern. A bullish fair value gap requires 3 candles moving towards the upside. And then if the first candle high and the third candle low do not touch, that area becomes a bullish fair value gap. And the reason why this is called a fair value gap is because since we had 3 candles of bullishness, not everyone was able to fill their orders, which means that the market leaves a gap in fair value, again creating a fair value gap. And as said before, a fair value gap is simply the area between the first candle high and the third candle low. If those two do not meet, then that area is a fair value gap. The same happens when the market is moving down and it creates a bearish fair value gap, when the first candle low and the third candle high do not meet. Now, there's multiple types of fair value gaps, and that's what we are going to talk about right now. We have the balanced price range. So the balanced price range is simply a bullish fair value gap followed by a bearish fair value gap. Since these two fair value gaps are going to overlap, we have this bullish fair value gap that gets disrespected and we create a bearish fair value gap. And when those two overlap, we have a balanced price range. The same thing when we start with a bearish fair value gap and that gets disrespected, and we have the move to the upside, creating the first candle high and the third candle high not meeting, giving us a balanced price range. Then we have the breakaway gap. The breakaway gap is defined by the third candle of the fair value gap. If the third candle of the fair value gap is disproportionately larger than the first and the second candle, that creates a breakaway gap. A breakaway gap is a fair value gap that should not be traded into. And the reason why is because in order to go all the way down towards the fair value gap, we would have to reverse the third candle's momentum completely, creating a bearish engulfing candle. And so therefore, a breakaway gap is a fair value gap that should not be traded into. Then we have the inverted fair value gap. So notice how we talked about the balanced price range. And in this drawing, you can actually see also a balanced price range. But first, let's talk about what an inverted fair value gap is. An inverted fair value gap is simply a bullish fair value gap that gets completely reversed, which means that the market closes below the bullish fair value gap, inverting it. And that creates the bearish inverted fair value gap. And this also applies with bullishness. Let's say that we have a bearish fair value gap. We can see it right here. Once that fair value gap gets disrespected, then we now create a bullish inverted fair value gap. So the 4 most important fair value gaps are going to be the normal fair value gap. We will see this a lot. We have the balanced price range, which is a reversal fair value gap, which is going to be incredibly important at higher time frame levels. We have the breakaway gap, which is important because sometimes we will expect a market to trade into a fair value gap, and all of the signs were in the fact that we are trying to trade a breakaway fair value gap. And then we have the inverted fair value gap, which is just like the balanced price range, a very important fair value gap to take into account at very key higher time frame levels. And very soon I will talk about a disclaimer about fair value gaps. This is incredibly important because this is what makes or breaks traders and fair value gaps. Now, what are fair value gaps used for? Well, fair value gaps are used for 2 things. 1, marking out the direction of the market, and 2, it's for our entry models. But when we're talking about the direction, it's 2 things. It's when we have a shift in market structure or when we have continuation in market structure. So if we go back to the different types of fair value gaps, you already know that all of the fair value gaps that will be be respected are marking the continuation of a trend, while the balanced price range and the inverted fair value gap are marking a market structure shift. And we will see very soon how this applies in our charts. And then fair value gaps have 3 levels to look for. We have the open, the 50%, and the close. These are the 3 levels to look for in a fair value gap. So the open will be the first level of the fair value gap. We have the 50% of the fair value gap, and then we have the close. And as you remember, if a candle closes below the close of the fair value gap, this now becomes an inverted fair value gap. But the most important levels for a continuation are going to be the open and the 50%. A fair value gap that is holding a strong fair value gap gives us a reaction either from the open or from the 50%. And then we have the levels of a bearish fair value gap, which are also the open, which is the first level of the fair value gap, the 50%, and the close. And a bullish inverted fair value gap is simply when we move bullish and we close above the fair value gap close. There's 2 low probability fair value gaps. Number 1 is when the third candle is opposite to the direction of the fair value gap, which means a bullish fair value gap in which the third candle is bearish is a lower probability fair value gap. The same thing when a bearish fair value gap is formed after a third bullish candle. And the reason why is because we want to see strong bullishness in the market. And the third candle being a bearish candle, it shows that bears are starting to take over. So therefore, this is a bullish fair value gap not to be trusted. And next up, we have a fair value gap that is not at a high value area. And this is where the disclaimer comes in. All of these concepts have to be applied in the right area of the chart, which means high value areas. If we are not at a high value area, you refrain from trading. You do not trade unless we are at a high value area. And the reason why I will show you on the charts right after I show you high probability fair value gaps, which simply are fair value gaps with a reaction out of a high value area. Just as I've shown before, all of these reversal fair value gaps are incredibly important when we have a reaction out of a higher time frame key level. And let me show you why. So now we are in the charts, and this is what is important to understand. This is the NASDAQ chart, and I want you to notice the huge reversal that we had. This huge reversal could be marked with one thing, which was a higher time frame key level, which was a very strong swing low that we had for weeks and weeks and weeks on end. We had not only one low, but we also had equal lows. So when the market moved all the way down, we came towards a very strong key level. And notice what happens to the bearish fair value gaps as soon as we react from that key level. Well, we have a bearish fair value gap right here that gets instantly reversed. And therefore, this key level was everything you needed for this next small detail. So once we have a very strong move to the downside and the market starts moving bullish, notice what happens to the bearish fair value gaps. The bearish fair value gaps start getting disrespected. And this is how fair value gaps show us the direction of the market. So the only question we need in order to understand what direction the market is going in is what fair value gaps are being respected and what fair value gaps are being disrespected. So for example, right here, when the market was still bearish, the market was respecting bearish fair value gaps. But as soon as we reach a higher time frame key level, all the way down here, then the bearish fair value gap starts being disrespected. And this is where the bullishness starts. And now let me show you another small detail. Notice how all of the bullish fair value gaps started being respected once we hit the key level. So we have a bullish fair value gap, another bullish fair value gap. If we push this to the side, we have 2 bullish fair value gaps. So right here and right here. These are 2 bullish fair value gaps. They get respected. Then we have the strong push up, creating another bullish fair value gap. We have another bullish fair value gap. And notice how none of these are being closed below. We had one that closed below, but that was simply because we had a bigger fair value gap that the market wanted to go into. Then we have another bullish fair value gap, another bullish fair value gap. And notice how, as the market is moving higher and it's losing steam, we are creating no bullish fair value gaps. And this is when we have the strong move to the downside. And so once the market reached the very important key level, this is where we started moving towards the upside. And this is why fair value gaps are very important to mark out the direction. Answer the question, what fair value gaps are being respected and what fair value gaps are being disrespected, and you will have the direction of the market. Now, if you want me to make a video on an entry model just using fair value gaps, nothing else, then just let me know in the comments and I will make sure to make it. I made this video to explain to everyone what a fair value gap is, what they look like, what they are used for, levels to look out for, and the quality of the fair value gaps. And just keep in mind, all of these fair value gaps require a higher time frame key level, because if you pair those two, the likelihood of you becoming profitable and calling the direction of the market correctly increases dramatically. So I hope you enjoyed. Let me know if you want to see the strategy video, and I'll see you then.